This video is called I Lost $128,000 in one options trade. Here's what you can learn.
$100,000 credit spread, and I ended up losing over $100,000. And I was just going to sweep it under the rug. I made this trade 2 weeks ago, but I think that if I reveal the trade, go through it, show you the risk management of this trade on Meta that I did 2 weeks ago before the market really pulled back, it's going to be a masterclass in how you manage, open, close a credit spread. And although I am embarrassed to put this video out, I spent a lot of time on it, and I think it's going to help improve your option trading game. And it's me just owning up to some mistakes I made, but also a learning lesson in the market on how to manage spreads. This was the biggest position that I ever opened up, and honestly, like, I'm kind of even like shaking to even like upload this video, but here it is. In fact, I just opened up a put credit spread.
Okay, I want to give Henry all the credit because it super sucks to admit your mistakes. It super sucks to admit your mistakes on the internet where everybody can judge you for it. But it takes a lot of bravery to do what he's doing. So I give him huge props for this. And I have been through all of this as well. And I have shared all of my losses all over YouTube. I have over 2,000 videos on there. So if you want to go back and look through my history as well, there are so many times where I talk about the losers I made and what I learned from them so I wouldn't do it again. So I really commend him for doing this. But I want to see how we can learn from this as well. And I'll add some of my own flavor to it.
Spread, and I just posted it to my Discord community. Put credit spread that I opened up is Meta 590, 580 put credit spread. And in this trade, I collected $7,500, and then I did the trade again 5 minutes later, collecting $7,600. So let's go over.
Okay, I'm gonna back up just a smidge. Paul had a great question. What is a credit spread in options? So I need to log in a trade here and show you what a credit spread is. So a credit spread is a defined risk and a defined profit strategy. Defined meaning you know exactly how much you're going to make and how much you're going to lose if either one of the outcomes happens. And we're going to do a live demonstration of what a credit spread looks like here. We're going to do a live demonstration of what that looks like here. And listen, I used to trade these. I will tell you for sure. I know exactly what he's going through. Give this just a moment to load up here. Sorry. Almost there. It says loading data, loading layout. Okay, cool. Let's go to Meta. Okay, and he said which strikes it was.
Put credit spread that I opened up is Meta 590, 580.
Got it. All right, 590, 580. Now that was before this pullback here. So it was probably sometime in February. So 590 and 580. So let me draw on the chart here. 590. We're going to make this red, and I'll show you why in a moment. And we're going to make the 580 green. Show you why in a moment. So this is the bought put, and this is the sold put. Okay, so maybe he'll tell us in a minute where he was when this happens, but when you sell a put spread, this is a bullish trade. You anticipate the price to stay anywhere above this point. I mean, literally anywhere. If it's at 590 and 1 penny, you're good. If it's at 5,090, you're good. Okay, anywhere above this point. Now, it'll help a lot if he tells us what date this was on. Okay, this was the date when Meta was at 619.02. 619.02. Let me see if I can find this, give or take. Oh, yikes. Oh, yikes. Okay, somewhere, it was probably this candle if I had to guess, March 12th. If I had to guess, I mean, the only day it was at 619.02 was 1, 2, 3, or possibly over here. Point being, it was at 619.02, okay? 619.02. So, in this scenario, Meta stock could stay at 619.02. It could go down to 590, or it can go up to anything. Anywhere in this area is profitable. Anywhere. That sounds really great, doesn't it? It sounds so good. The stock can go up, the stock can go down, the stock can go sideways, and I'm going to be profitable on the trade. That sounds freaking awesome. But there's a huge problem with this. And he says he put it on, let's see.
Put credit spread. And in this trade, I collected $7,500. And then I did the trade again 5 minutes later, collecting $7,600.
Oh, wow. He had 200 lots on the spread. Okay. All right. Holy moly. Okay. So he sold one of them for $1.27. No. He sold 217. He sold it for 217, and then he bought for 127. No. Yeah. Oh my gosh, what a bad trade. No, this can't be right. This is right. Holy crap. This is a terrible trade. And I don't mean this to judge Henry at all, but okay. Hang on. We're gonna have to do some math here. Don't save. We're gonna have to do some math here. I'm so glad he put this out, but this is a terrible trade. Okay, so he sold the 590 and he bought the 580. And so when he did that, he took in a credit of a 217 for the strike he sold, and then he bought 127. So his net outlay equals 217 minus 27. So he made 90 cents per trade. If I did this correctly, right? So he sold 200 times 217, and he bought 200 times $1.27. Yeah. So he was this times 200. That math isn't right. What am I doing wrong here?
So let's go over opening, closing, managing the strategy, why I opened it to.
Okay, hang on. The math isn't math in here for a second here. $580, $590 times 200.
580 put credit spread. And in this trade, I collected $7,500. And then I did the trade again 5 minutes later, collecting $7,600. So let's go over.
Oh, hang on. Maybe average credit. Okay, there it is. That's what I wanted. Thank you. That's what I was looking for. The average credit was 76 cents. So between those 2 points, he made 76 cents. He took in 76 cents on a $10 wide spread. So 0.76 on a $10 wide spread. So his risk in each one of these was $9.24. What does that mean? $924 per one lot to make $76. So let me spell this out. To make $76, he risked $924. Okay. So, but in theory, 76 divided by 924 is an 8.2% return. So in theory, that sounds good, right? That sounds great. Hey, who wouldn't want to make 8.23%? The problem here is how many times does he have to trade this to get back to break even on one loss? On one loss, he has to do 924 equals this divided by this. He needs 12 trades to get back to break even in options, to get back to break even. So if his trade loses, if instead of going up or sideways or down a little bit, if it goes down like this, which it did, his max loss is $924 per contract. And he did it 200 times. Yikes. That's a big yike. Big yikes. Okay, so let's let him continue on here. I can't really duplicate this because meta is so much less now, but it would be as if he sold, let's say $20 below. So if meta's current price is 543 and we sold puts at let's call it 522 and a half. So he would sell the 522 and a half and then buy not the 520. Hang on. Could buy the 512. There you go. This would be equivalent to what it would look like. Equivalent-ish. But even this one was at 222. So I don't know how he got such bad pricing. But anyway, let's let Henry continue to tell his story here.
I collected $7,500, and then I did the trade again 5 minutes later, collecting $7,600. So let's go over opening, closing, managing the strategy, why I opened it to begin with, and what I saw within Meta to open up the strategy. Of course, it takes me some time to edit this video, so if you want all of my trades live, then go ahead and check out the first link in my description. Now, a put credit spread is selling one put option and buying another put option that's lower. This provides you a defined risk, and it uses very little capital to collect good premium. This is best to do when a stock is either bullish or it's moving sideways. Check out Meta right now. Meta was trading for over $700 per share. The stock had a very big pullback and pulled under $600 per share. But under $600 was just way too cheap, and investors have pushed it back up to $617 per share. The reason why I opened up this trade is because I see a technical support at $600 per share because there is such a big bounce right now going on. And because there's a huge bounce and there's a lot of investor demand, as well as look at the RSI, it's coming back up, and the RSI went all the way down to about 32. To me, Meta was very oversold, and I think this company is a very good long-term investment. That's why I personally decided to open up the 590 and 580. So I sold the 590. You're always looking to sell the higher strike price. The reason why you want to sell the higher strike price is it's worth more money.
I'm also noticing his audio and video are out of sync. Just before y'all comment on it, I see it too.
And then you buy a lower strike price, which is worth less money. And by selling one thing that's worth a lot more and then buying something that's worth a lot less, you get to profit from the difference, which is why it's called a spread. All right, so look, now it's been 1 week. I was going to post this video 1 week ago, but I want to go over what happened with the meta trade. Again, I was going to sweep it under the rug, but I think this is just the most valuable learning lesson. And despite me being embarrassed, I actually handled it pretty well. And I want to discuss the position. Now my portfolio is at 3.3 million. I've actually done okay, very similar to QQQ. But this meta trade, I'm going to go over the results right now. And yeah, it's a tough position, but I ended up actually saving money, and actually a lot of money. So what you'll notice right here is that on the 24th, I ended up making the 7,500 to 7,600 that you saw earlier in this video. But I then closed it on expiration. And it was the craziest expiration because the day before expiration, Meta was actually well away from being in the money. See, when I opened up this trade, Meta was trading for over $620 per share. But subsequently, every single day, the stock dropped. And the day before, I still ended up holding it. Now, the reason why I was holding this position was because it was still out of the money. And of course, I didn't really know that we're going to have the whole tariff situation with the market going down and crashing. So what ended up happening on 328 was that.
Okay. Thank you for giving us some context of dates. So he actually did it here. He actually did it here. And then 328 was when things went sideways, right? So first, here's a giant fundamental problem with this trade. He's putting on a bullish trade in a bearish trend. Do we see that? Comment 10, 20, 50 if you see that, right? The 10 is under the 20, price is under the 50. So that's the first giant fundamental issue with this problem. He didn't have to do this trade. He chose to do this trade because he felt like there was a support level at 600. But the trend was down. Not only was the trend down on the stock, the trend was down in the market. If we go on to March 25th, which is this date right here, right, 10, 20, 50, you're still crossed down. Even though price was over the 10, price was even over the 20, the trend was still down. Okay, so that's a huge flaw, right? And this is so important. This is so important. 40% of the market, 40% of the move of your stock is due to the market. 30% is due to the sector. So let's go to the tech sector on March 28th. Not SLK, it's XLK. March 28th looks about the same, right? This little pop right here, March 25th to March 28th, still going down. So the market's going down, the sector's going down, and even the stock is going down. I don't know why anybody would take a bullish bet at that point, especially a bullish bet with the risk to return so skewed in the opposite direction. So skewed, right? I would rather risk 76 to make 10 in this regard, like buying a lotto ticket basically, versus risking 10 to make 76. That's equivalent to what we're saying here. The big difference. Big difference. Everybody's understanding the 10, 20, 50. I wish Henry understood the 10, 20, 50. 3.0 should be coming out this week. That's the plan. Wayne says he was the last guy who I subscribed and unsubbed to after knowing about Outlier. Well, cool. I'm glad to help with that. Yeah, this setup here was not this. Okay, this was a high risk setup from the jump. It was a high risk setup. for the fact that he was making that little on his spread is crazy to me. Really crazy. He might have sold it and then realized things were not going that way, so he bought the puts to help offset that, which is why his credit may have been so small. But if we were to do this today, we would be getting $2.22 in credit versus just 76 cents in credit. Big difference. You know, what is that? 3 times as high, basically. 3 times as high in credit, which means 3 times less risk in this case. So yeah, let's continue on.
That Meta ended up closing at, 590, or actually went even lower, went down to 579, excuse me. So what ended up happening though was I would have lost $200,000. That's why I'm making this video. And as embarrassed as I am to post this video of like a huge loss, first of all, I'm owning up to a loss. And second of all, I actually managed this trade perfectly. Like going into like a market crash where Meta pulled back like crazy in one single day, well beyond norm, well beyond like what the Bollinger Band would say, something that like I could not really forecast ahead of time. This position, because I opened up 100K, 100, like you can see right here, it's 100. The quantity is 100 and the spread is 10. So this is a 100K trade as well. It's $200,000 worth of risk. And I ended up closing this position for $128,000, even though on Friday of expiration, had I held, I would have lost the full 200,000.
Oh, yeah, he held this right up to expiration. Another issue. So options always expire. And so like up here in Trader, you can see the different expiration periods. Like this one is just 3 days out. This one is just 3 days out. But you could do something that's 250 days out. You could do a trade that's 250 days out. My wheelhouse is I start at basically 21 days. I always look at the monthly contracts as well. Monthly meaning like that's the one that has like a lot of stocks have weekly contracts and a monthly contract. But all stocks that do options will have a monthly contract to start. That's the one that's going to have the highest liquidity across all of them. And that's where I go to. And so for me, I wouldn't, I mean, first off, if you remember my trade where I talked about where I blew up my account on the elections in 2016, it was because I was putting trades on Tuesday that were going to expire on Friday. I didn't even give them time to work. There was no time for my trades to work. And it may have been a similar situation here. You put it on Tuesday, it expired on Friday. When you do that, you're taking unnecessary risks. So I look at 21 days because in general, the outlier signals are between 15 and 25 days. So 21 days is where I start. I might go a week earlier. I might go a week later based on liquidity, but that's where I start. And that gives you time, right? That gives you time for the trade to work. Whereas if this expires because you have so little time, you could lose the entire investment almost overnight, it seems like. Almost overnight in this case. So that was another flaw in this plan. And I don't want to criticize him because he's getting enough criticism by putting this out on the internet already. But these are things that we can learn from it, right? These are things that we can learn from Henry taking the time to share a loss of his, which I really appreciate. So number one, trying to go long in the midst of a downtrend. That's a huge mistake. Number two, not giving himself enough time to be right in these trades. That's a mistake. Number three, setting it up in a way where he's taking unnecessary risk. If you want to be long, just buy a long call. Buy a deep in the money long call. Then you don't have to stress about all this. So there's a lot we can learn from this.
Full $200,000 because 328, the stock ended up closing under 580. So my lower bound, as you guys saw earlier in this video, the lower bound was 580. So it closed below 580. So had I held, I would have lost 200K. But I made the decision that because things were not going according to plan, and I literally waited minute to minute, and I was thinking, do I close it? Do I hold on to it? But ultimately, I saw that based on RSI.
I'm glad that he also mentioned this too. I don't know if he had a plan for this. Because he just described, should I do this? Should I do that? Should I do this? Should I do that? The issue really comes down to what's your plan? What is your plan? You should have that plan ahead of time. I'm not sure what's going on with the echoes. Let me restart the screen sharing. Maybe that'll fix it. Okay. But yeah, you should have a plan ahead of time before you do anything. And I'm not sure you did.
based on RSI and based on the momentum, the trade just wasn't going well. And as much as I want to be a bull, and I am very bullish on the market over a long period of time, and I've been right for a very long period of time, sometimes it's just not it. Sometimes you just have to cut your losses. And this was really difficult for me because I am a bull.
And that's true. Sometimes you're not right, and that's okay, right? There is no shame in losing trades. There's no shame in losing trades. But to hold on to a loss and let it get bigger and bigger, or even worse, buy more, is amateurish and self-destructive. There's no shame in losing trades, not at all.
I made tons of money over the past decade, but this was the biggest trade of my life. And if you actually think about it, though, it was well within some of the risk.
I have no idea why there's a major echo. Thank you guys for telling me. I've not changed. I've not changed anything. Yeah, I don't know.
Management rules, because this $200,000 trade at the time was about 5% of my portfolio. So keep in mind, I know some of the comments might be like, well, Henry's a complete idiot for going $200,000 on spreads. Keep in mind that within my community in Discord, what I teach is proper risk management and position sizing. So this position size, although is astronomically high for the viewer you watching right now, it was somewhat reasonable for my portfolio size of 4 million. Obviously, each trade is between 1 to 3, maybe 5% at most. So this trade was about 5% of my portfolio, and I lost a lot of money. However, it was actually a great lesson in terms of managing risk, because the last day I saw it wasn't going my way. I ended up closing this, and you can see the close right here was actually 12:22. So it was just early in the afternoon. I ended up closing and losing not the whole $200,000. So I ended up losing $128,000. Not to mention I did collect about $15,000 here. So I ended up losing $112,900, which is very, very high. However, this is a really good learning lesson that on the last day of expiration, it is always best to wait till the last day. Although
no, I disagree. You should be well on your way for trades like within the last week. In fact, I have a slide for this. Let me find the slide real quick. 1 week before expiration. A week before. Oh, like Friday, it's going to expire next Friday. This Friday, what am I planning on doing? Am I already profitable? If no, then I'm going to close the trade. The reason being is that with options, you can get yourself into so much trouble at expiration that you don't have to take. So much issue you don't have to take. I'm not going to play any more video because there seems to be some issue with the echoing, and that's okay. We can still make great lessons out of this. So 1 week before expiration, am I already profitable? If no, I'm going to go ahead and close it. It's too much risk. Can I roll out and potentially up for a credit? If no, I'm going to go ahead and close it. And this is talking about rolling the orders. But like this is my rule, that if I'm not already profitable a week before expiration, there's no sense in holding it, right? And what do I mean by that? What do I mean? If I'm getting in a trade and it's dead money, maybe it's going sideways. It's dead money. Maybe it's going down against me. It's dead money. Things aren't working. It's up to you. It's up to you to know when to get out versus when to stay in. It's up to you to know when to get out versus when to stay in. And if you aren't already making money and you're coming up against this window where your trade is going to be worth 0 pennies at all, or you're going to be profitable. Personally, I would much rather just get out of the way than have that. It's called gamma risk. I would want to get all the way out of the gamma risk as fast as I possibly can. So let me do this. Let me introduce myself real quick. And then I actually want to hear from you. What did you learn from this video? Now, of course, there was probably a lot more to it. I don't know what's going on with the system causing these echoes, but we're going to see, what did we learn from this video? My name is Christopher Yule. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009. And this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And don't forget about the Outlier 3.0 giveaway over at outlierdeal.com. In fact, let's go over there real quick. outlierdeal.com. OVTLIRdeal.com. We're going to be giving away $1,000 and a year of Outlier 3.0 for free for the top winner. We already have 6,955 entries. That's so cool. First runner-up gets $200 worth of merch plus my 5 favorite trading book bundle. And the second runner-up gets $150 worth of merch and my 5 trading book bundle. So all you got to do is go to outlierdeal.com, put in your name and email address, and do us a couple shares if you don't mind. The secret codes are all gone by now. So if you haven't got a secret code, it is far too late, or you can watch them in the replays. So let me see what you said in the comments. That's what I want to know. What did you learn from this? Nathan says, I learned that this video is a 7, or probably maybe a 3 or 4. Nobody gets a 7. Christopher just paid his taxes. Yeah, dude. I know. I know. Random guy says, stay away from options until you are fully confident of your understanding of them. Yeah. And I had this conversation with Steve Burns, one of my mentors. And I was talking about selling option spreads, just exactly like Henry was talking about here. And I've been struggling with these, and I would literally have an 84% win rate with these, yet I was losing money in my account. I didn't understand why. And Steve said to me, he said, yeah, Chris, I used to trade that way too, but then I realized I wanted to make money. And that was such a slap in the face to me that it changed my entire worldview. My entire worldview in one sentence. I used to trade that way too, but then I realized I wanted to make money. Okay, got it. Understood. Not doing that ever again. And the reason being is that you have so much more risk than what you are willing or could even potentially make total. And if he's making 76 cents for every $924 he's risking, that is a huge amount of risk. It will take him 12 trades to get back to break even on one loss. You now need 12 perfect trades in a row for each one loss you take. This is a negative sum game. This game is not going to work out. Even if you're right 90% of the time, that means you lose 1 out of 10. You still need 12 to make up for the 1 that you lose. Yeah. So I only trade long calls, long puts, deep in the money. Deep in the money because a couple of reasons. First is the options decay rate. So first thing is that all options have extrinsic value. Extrinsic value goes to 0 on every option, on every strike, on every stock, on every expiration, every time. It goes to 0. And option sellers are trying to exploit that. They're trying to say, okay, well, if it goes to 0 every time, then if I sell the option, then I get to collect the premium. The problem here is that you have to wait. You have to wait all this time to get your premium. But by trading long calls, long puts that are deep in the money, I'm paying as little as I can for that extrinsic value. And I'm just trying to get the delta moves. I'm just trying to get the stock move in it, right? So if I can get in and get out a few days later, then my decay on the extrinsic value should be small. I'm trying to keep that as small as I can. But if you are the option seller, you have to sit there and wait. And this right here is the insidious. I call it insidious because it is so alluring, yet this is what causes the problems. It's so insidious to think that I'm going to sell my option. I have time, right? If let's say I had 2 weeks for this trade to work, I have time for it to work. And over those 2 weeks, as long as it goes up anywhere over here, by the end of the 2 weeks, I'm good. I'm not going to stress about it. This is such a great example. But if like this, it goes down and continues to go down over those 2 weeks, what happens to you? You get yourself in a bad position because it's already a problem that continues to get worse, and you hit your max loss. You hit your max loss, and it gets even worse and even worse. So for me, trading long calls and long puts deep in the money, roughly 80 delta, that's my wheelhouse. And then I don't have to stress about it. Either the trade's going to work or it's not. And I don't have to sit there for weeks hoping that it comes back. Because with the insidious nature of selling options, you sit there and you hope and you hope and you pray that it will just happen to come back. Versus looking at it objectively saying, this isn't working. I got to go. I got to get out of the way. So to Ween's point, I used to overcomplicate option strategies. I was there too, my friend. I've been there and I've just simplified it down to long calls, long puts. That's it. Getting into iron condors, which I did, butterflies, which I did, straddles, which I did. After learning from Chris with just a simple buy call / put option, we can simplify things so much. Yes, for sure. I learned that you can lose a lot of money selling options. You can lose tremendously more than you can ever make, way more than you can ever make by selling options. I love hearing you guys' lessons. This is the important part of why we do this. What are you learning from these? OCX says, is the slope of the 50 also an indicator too? Like if it's not positive yet, not a good time to buy. Absolutely. If the 50 EMA is moving down, then yeah, the trend is moving down. If the 50 EMA is moving up, then the trend is moving up for sure. For sure. Let's see. Quentin says, credit spreads require too much time and management, particularly when you decide to close the profitable leg and then try and manage the losing leg. Yeah, there's a lot that you can do with these that you don't have to. It really does overcomplicate things. Great point. Let's see. Georgia says, I learn to know what you do before you lose it all. Too scary for me to see the upside and not the downside when you trade. Yeah, which is why I thought this was a great video, because we can actually learn from this, and I appreciate him talking about it. Inkari says, I don't understand options, so I decided not to do them, and that's okay, for sure. Nico says, trade risk first. Yeah. Georgia says, no stocks are good. That's right. All stocks are bad. No stocks are good. Every once in a while, they act right. Nathan says, I wouldn't want to make this trade as much as I would not want to be on that all-female Blue Origin. Okay. Dylan, hey, Chris, can you check the order blocks on Celsius? Just for you, Dylan. Just for you. Nobody else. Got an order block up here on 3906. Around 3906. Manny was yelling, so I appreciate him making that context. So the key to trading options is trading long calls and long puts deep in the money? For me, yeah. For me. Theo says, I feel like options are more towards gamble, trying to guess the price at expiration time. Not necessarily. It's a leveraged investment. It's a leveraged investment if you're doing them in the money. It is a hope that it's at least above. Let's go to Meta real quick. It's a hope that it's at least above the strike you sold if you're doing out of the money, if you're selling spreads. And if you're doing something way out of the money, like buying calls way out of the money, that's just YOLO gambling. That's just buying lottery tickets, hoping for the best. So you really have three different things here, right? Leveraged investment, selling puts out of the money for a bullish call is a hope and a prayer that it works out, because I have to hold it day after day for the price to come in. And then if it's out of the money calls that I'm buying, then that's just a lotto ticket. So three very different perspectives on essentially nearly the same thing. Isn't that crazy? Isn't that crazy? Salty Brad, is there a difference between rolling for a credit versus rolling for a debit? Yes. If you roll for a credit, you reduce your risk, because think of it this way. You buy the option. Let's say you paid $5 in debit to buy the option. If you roll it for a credit and you take in $1, now the risk in your trade is $4. You've actually reduced your risk in the process. But if you roll for a debit, that means you went from your trade costing $5 to maybe $5.50. You've added risk to the trade. And by adding risk to the trade, you're probably not profitable already, I would guess. Because that's not usually how it works. But great question. By rolling for a debit, you take on more risk. Lubiter says, the process of learning takes time. Thanks, Chris. Yes, and that's why I think it's great to hear from you guys. Learn the Greeks, then trade the options. You can do that. You can do that. For sure. The only guy on an off. Okay, not doing that. The mic, Chris. The mic, Bobby. So great learning from someone who knows what he's talking about. Thanks, Chris. You're no random guy. I may be a random guy, but so are you. Okay, so let's do one quick look at what the market's telling us real quick, and then we'll get out of here. What is the market telling us today? So this morning, the SPY is up bigly. The SPY is up huge. I am such a genius. The market is going up. I'm going to sit on my toilet all day for my golden throne, and I'm going to text, say, now is an incredible time to buy. If you're not buying, you are so stupid. You must live in China if you're not buying, because China is stupid, and you must be from China if you're not buying. Point being, the market is up this morning. We've got a cross over the 10 EMA, and real quick on the cheat sheet, just so we're all clear. I got this from Steve Burns. The 10 EMA is the indicator of the short-term trend. So if it bounces over and holds over the 10 EMA, that can be the change in short-term trend, which is what I was trying to tell you in our Sunday video. But the 10 still under the 20, price is still under the 50. So you still have a very bearish trend going on right now. And then if we look over at the breadth, our market breadth measures how many stocks are on the bull list versus the bear list. You're not going to believe this. We have 46 buy signals today and only 1 sell signal. So if we look at these, on a chart, we can see here that market breadth is starting to roll back up, starting to roll back bullish. And if we throw a 10 EMA on top of it, we have that crossover today. So while it is a bearish trend, we're getting more and more stocks getting buy signals. And more stocks getting buy signals means more and more stocks are looking like this, where people are screaming buy, buy, buy. And that's going to help push the market higher. So this is what we want to see. This is what's telling me we might be hitting near a bottom. Love the Chris voice is great. Trump. It's a mediocre Trump voice at best. It's mediocre. So let me see if I can find my slide real quick. I hope that was useful to you. And be sure that you come back this afternoon. If you're ready to save time, make money, and start with less risk, head on over to outlier.com to save 64% off the monthly price by getting it for just 82 cents a day. And of course, come back this afternoon where outliers like us will save time, make money, start winning with less risk together as a team. YouTube is going to pop up a couple recommended videos. I recommend you watch for them. I recommend you have a fantastic day. We'll talk soon.